Take a moment to look at this chart. This company went public in September 2020 at roughly $10 a share. It tripled during the meme stock era, collapsed back to $6, and then did something almost no enterprise software company has ever done. It went from $6 to $207 in less than 2 years. That is a 34 times return from the low. Today, it sits at around $146, down 29% from the peak, with a market cap of $350 billion. Revenue grew 70% last quarter. Adjusted free cash flow margins are above 50%. Rule of 40 score of 127, among the highest in enterprise software history. And yet, Michael Burry says Anthropic is eating their lunch, and the internet's favorite debate is whether this company is the most important software business in the world or just an expensive wrapper around someone else's AI. Both sides are arguing from a place of misconception, and in this episode of the Liam Highland Portfolio, you'll know exactly which numbers settle this debate. It all began by building a system to structure all the hundreds of claims made about this company. Every filing, every earnings call, every analyst note, every bear argument, every bull argument, into a single framework with all the exact signals and KPIs that tell you whether the bear, base, or bull case is in play. Palantir does something similar for enterprises at a much larger scale, and that similarity is not a coincidence. It is the thesis. So here is what we are going to cover. First, what Palantir actually does. Then, the key insight most investors skip entirely, why Anthropic and Palantir sit in different data layers of the same stack, and why that distinction matters more than the entire bear versus bull debate. Then I'll evaluate Burry's argument against the actual evidence we have. And finally, the exact numbers to watch at each earnings date so we can track which case we're actually in. Let's begin. A large enterprise generates data from hundreds of systems. Transaction logs, sensor data, supply chain events, HR records, customer interactions, regulatory filings, all produced by different platforms, in different formats, often in different countries. The finance team sees one slice, operations sees another, compliance sees a third. The AI, if you point it at any one of these systems, gets a fragment. Sure, it can generate an answer, but it cannot see the whole business. What Palantir does is map all those fragments into a single governed model of how the business actually works, what they call an ontology. Not just the data, but the relationships, the business rules, the workflows, the permissions, a digital twin of the enterprise's operational reality. Think of it like your own life. Your bank will have your finances, Whoop has your sleep, and MyFitnessPal has your diet. Each one knows a piece of you. None of them know the whole you. Palantir builds that unified model, but for organizations where the stakes are military operations, hospital systems, or billion-dollar supply chains. That distinction, fragment versus a governed whole, is the entire Palantir debate. Every argument about the stock comes back to whether that governing layer holds its value. Now, to understand why it might hold its value, you need to know where it sits in the stack. Enterprise data architecture has roughly 7 layers. At the bottom, we have data capture. These are the sensors, logs, transactions. Above that is storage, Snowflake, Databricks, AWS. Then above that, we have compute and transformation, things like dbt, Spark, Palantir's own foundry. And then we have the 4th layer. This is the layer that matters, semantics and rules, where raw data becomes business meaning, where table 789 column 12 becomes active customer or high-risk policy. Palantir calls theirs ontology. dbt calls theirs the semantic layer. Same concept, different implementations. Then sitting on top of the semantics is reasoning. This is where Claude, GPT, and Gemini sit. This is Anthropic's layer, the brain. Above that, we have the actions and orchestrations layer. Triggers, workflows, approval orders, rerouted shipments. And wrapping around everything is governance. Audit trails, access controls, compliance. In defense and finance, governance is the product requirement. Now remember the stack, because one of these layers is where the bears think the value is collapsing, and I think that is a mistake. Here is where the competitive narrative gets reframed, and this applies to Palantir, to UiPath, to every enterprise AI company. It is the cost of intelligence. Current frontier pricing, what's called tokenomics, is Claude Opus at $5 per million input tokens, GPT 5.4 at $2.50. Those sound cheap per query, but multiplied by production volume, a supply chain dashboard refreshing every 15 minutes, fraud detection running continuous queries, logistics routing thousands of decisions per hour, and the token bill for having a frontier model rederive business meaning from raw tables on every execution becomes orders of magnitudes more expensive than defining the meaning once. This is the exact same insight I covered in my previous episode on UiPath. Just like you would not pay a PhD salary to do filing and data entry, you are not going to route every repetitive enterprise task through the most expensive model. You want the cheapest intelligence that can reliably do each task. We have deterministic rules for the repetitive stuff, lightweight machine learning for classification and anomaly detection, fractions of a penny. Small models for document processing, these are cents. And then we have frontier reasoning for the genuinely hard and novel problems. These cost dollars, a small fraction of total volume. And the orchestration layer decides which level of intelligence to invoke. An ontology is what makes that routing possible. Without it, the system sends everything to the frontier model. With it, the system knows which intelligence level each task requires. So the ontology is not just a context layer, it is also performing an efficiency function, and that does change the Anthropic argument completely. Now here's the evidence. DBT Labs published a benchmark this month, text to SQL versus semantic layer, tested with the latest models. Now, I should flag that DBT does sell a semantic layer product, so they have a commercial interest in this result, but the methodology is open source and reproducible, so I'm comfortable citing it here. Text-to-query accuracy doubled from 33% to 65% between 2023 and 2026. After additional modeling, it hit 90% with Claude Sonnet. The semantic layer hit 98% to 100%. But here is what the bears miss. The issue is not accuracy, it is the failure mode. So what do I mean by that? Well, when text to SQL gets it wrong, it gives you a plausible but incorrect answer. The number looks reasonable, they are, however, wrong. When the semantic layer cannot answer the same question, it throws back an error. For a board deck, a regulatory filing, an auditor, that difference, that failure mode, is crucial. And even if models eventually reach 99% text-to-SQL accuracy, 5,000 queries a day means 50 wrong answers daily that look identical to the right ones. The semantic layer makes the system deterministic. Same question, same answer every time. You cannot get that from probabilistic inference regardless of how good the model gets. So the model's improving does not eliminate the need for the semantic layer. It changes what the semantic layer is for, from capability towards determinism, governance, and economics. The moat shifts from the model can't do this to the model shouldn't do this because it's wasteful. And that is durable because compute costs money and always will. So now that we have the full data architecture stack, we need to understand which parts commoditize. Storage, compute, ETL, already commoditized. Snowflake, Databricks, AWS all compete aggressively in these layers. Reasoning is commoditizing. Models are getting cheaper every year. But the semantic layer, the ontology, is actually where things get interesting because it splits into two different layers that commoditize at completely different speeds. First, we have standard definitions. What is a policy in insurance? What is a trade in finance? These are industry data dictionaries. Finance has FIBO. Insurance has ACORD. Healthcare has this. Databricks points customers to common data models like FHIR. This layer commoditizes. It is a standardized output. The second layer is the company-specific wiring. Two hospitals both have patients, admissions, prescriptions, same nouns, but at Hospital A, the receptionist uses an intake system from 2009. The nurse uses a separate clinical system. The pharmacy runs on a third. There is a shared spreadsheet the night shift uses because the main system goes down at 2 a.m. every Tuesday. 13 years of workarounds, 3 acquisitions of clinics, each running software that was never fully migrated. Hospital B has entirely different systems, different workarounds, different mess. Same nouns, completely different wiring. That wiring, how data actually flows through a specific organization's real systems, that is what Palantir maps. No template captures it, and the mess is not temporary. It is the business. It regenerates with every merger, every regulation, every change, every acquisition. So the standard definitions commoditize, while the company-specific wiring doesn't. That distinction is what decides whether Palantir has a moat. And there is a historical pattern here. When underlying technology commoditizes, value migrates upward into integration and governance. With ERP, big companies chose integrated platforms because the integration cost exceeded the premium. With cloud, the narrative was that everything is going to public cloud. But ultimately, it became hybrid between on-prem and cloud solutions. And in modern app estates, Salesforce reported that enterprises average 957 apps. Only 27% of them are integrated. So what we see is that modular wins in simple environments, while integrated platforms win where complexity and governance matter. And ultimately, the market segments, and both survive. And I'd estimate on a directional basis that standard definitions are largely commoditized now. Company-specific wiring for simple enterprises, maybe 3 to 5 years. For complex enterprises like defense and intelligence, large regulated commercials, I'd guess 7 to 10 plus years, if ever, to fully commoditize, because the complexity regenerates faster than tools can standardize it. So let me evaluate Barry's argument directly. He reiterated this month that Anthropic is eating Palantir's lunch. I have not seen a primary source letter, so I'm working from the public argument as reported. His core claim? Enterprise AI value is collapsing into the model layer. Palantir's surrounding layers do not justify the valuation. He makes 4 supporting claims. Claim 1, enterprises are choosing Claude directly. Ramp data says 24% of businesses are using Anthropic, which is winning 70% of head-to-head purchases against OpenAI. Nice. But look at what the Ramp data actually measures. API spend. Tokens for chatbots, copilots, document processing. It's not measuring infrastructure replacement. A company can buy Claude for reasoning and Palantir for operational integration. Different budget lines. And some of Anthropic's revenue literally flows through Palantir's platform. AIP routes Claude tokens as a pass-through. Claim 2 is that Anthropic's growth massively outpaces Palantir's. Anthropic's ARR went from $9 billion to $30 billion. Palantir took 20 years to reach $5 billion. So the numbers are correct, but the comparison is misleading. Anthropic sells tokens, a consumable that scales with every employee. Palantir sells enterprise platform subscriptions and usage. And then there's little evidence that enterprise AI token spending is actually displacing existing infrastructure. This is exactly the early cloud pattern. Every CTO bought AWS between 2012 and 2015, but that spending was experimentation. Core workload migration took another 5 to 10 years and went hybrid. The adoption is real, the displacement is not. Those are different things. Claim 3 is that Anthropic is easier to deploy. And that's true. Claude API takes minutes. Palantir takes weeks to months. But again, the comparison is misleading. Easier to deploy and solves the same problem are different claims. A calculator is easier to buy than a Bloomberg terminal. That doesn't make them substitutes. But Barry knows this, and that's where he gets his 4th claim. Palantir is a glorified systems integrator, and organizations will build these themselves directly using Claude API. This is Barry's conclusion, that Palantir is a wrapper around someone else's intelligence, and value is collapsing into the model layer. If true, you would see declining margins, declining retention, slowing growth. Here is what the data actually shows. Adjusted operating margin, 44% to 57% through 2025. Net dollar retention, 139%. US commercial growth, 137% year over year. Customer count, 954, up 34%. Top 20 customers revenue, 64.6 million to 93.9 million. Every metric that should be deteriorating if the wrapper thesis were correct is accelerating the other way. But those were adjusted margins. What about stock-based compensation? Fair question. SBC was 13% of revenue in Q4 2025. GAAP operating margin is materially lower than the 57% adjusted figure. I am using adjusted because that is what the market prices on for high growth software, but the gap is real and worth knowing about. The trajectory, however, is improving. SBC as a percentage of revenue has been declining, but it is not a trivial number. And then on the customer count, one would say that 954 customers after 20 years is a small number. Salesforce has over 150,000 customers. Databricks has over 10,000. If Palantir's addressable market is genuinely only 3,000 to 5,000 complex enterprises globally, the revenue ceiling is lower than the 350 billion market cap currently implies. That is a legitimate concern and one we are watching. But those are all trailing results. Burry is making a prediction here, so we need to look forward. Contract backlog is at $11.2 billion of remaining deal value. The 10K notes this assumes option exercise and no client terminations, so take that number with appropriate caution. But are they terminating? Not at the moment. Deal sizes are expanding. 61 deals above 10 million in Q4, 4.262 billion in total contract value. You see, Palantir is model agnostic. AIP supports Claude, GPT, Llama, Gemini. Model commoditization is actually a tailwind to model agnostic orchestration, just like Palantir. And then there's government with 54% of revenue and operates in classified environments where public API is not an option. Maven is being adopted as a program of record. The Army agreement has a ceiling of up to $10 billion over 10 years. So for Burry's thesis to print, you need deal sizes shrinking, net dollar retention falling, customer expansion slowing, backlog stalling, while model revenue continues to surge. None of those are present. Several, in fact, are moving the other way. Now, the bulls make the opposite mistake. The strongest bull case? Once Palantir is embedded, it becomes the operating system. Switching costs compound. In government and defense, nobody else can credibly replace them. It's a serious argument, but too strong at the extreme. Firstly, at 954 customers after 20 years and billions in investment, the operating system for enterprise narrative is extremely early. Palantir needs to prove it can scale beyond a few hundred complex organizations into thousands. If the addressable market is smaller than the stock implies, the growth story has a ceiling. Second is that the standard definitions layer within ontology is commoditizing. We have dbt semantic layer, Databricks Unity Catalog. These are real products. A mid-market e-commerce company with clean data in Snowflake doesn't need Palantir today, and it will not need it in 2 years' time. Thirdly, AI is getting better at mapping systems automatically. Today, a hallucinated data relationship in a military system is catastrophic, but the models improve at code understanding every year. The risk is not that the model replaces the ontology now. It is that the complexity tier shrinks. Fewer enterprises qualify as genuinely complex over time, further shrinking Palantir's total addressable market. For the extreme bull case to crack, you would see things like net dollar retention declining as customers choose to maintain their own ontologies with cheaper tools. We would see government win rates dropping as competitors achieve comparable accreditations. We'd see large commercials pausing expansion after initial AIP deployment. None of these are present today, but those are the signals. Now, both camps are partially right. The question is, what is the stock actually worth given where reality sits? Now let's talk about valuation. Here is what we know. Full year revenue is 4.475 billion. Guidance for 2026 is 7.182 to 7.198 billion. Adjusted operating margin is 57%. Adjusted free cash flow at 1.25 billion in FY25. Rule of 40 at 127, cash at 5.2 billion, and debt is effectively zero. The market cap is around 350 billion. Subtract the cash and you get an enterprise value of roughly 345 billion. On trailing revenue of 4.475 billion, that is 77 times trailing revenue. On forward revenue of 7.2 billion, it is 48 times. On trailing adjusted free cash flow of 1.25 billion, it is 276 times. For context, the median high growth software company growing above 40% trades at around 15 to 25 times forward revenue. Palantir trades at 48 times. CrowdStrike trades at roughly 20 times. Snowflake at roughly 17 times. The premium is enormous. So the question is not whether the business is good. The business is exceptional. The question is whether the stock is priced for perfection or priced for reality. Here is how to think about the three cases. I've gone through every primary source I could get my hands on. Earnings calls, 10Ks, shareholder letters, third-party research, and curated 301 unique claims. Every one of these maps to one of 12 distinct signals. We've got things like commercial expansion, revenue durability, bookings visibility, government entrenchment, platform advantage, profit quality, enterprise AI competitive position, geographic mix, customer expansion, governance, ethical and regulatory acceptance, and valuation risk. Now, not every signal matters for every case. For example, the bear watches 10 of these, the base watches 9, while the bull case watches 11. For the bear case, revenue growth decelerates from 61% guided to the 30 to 35% range by Q4 2026. US commercial cools below $550 million per quarter. Multiples compress from 48 times forward revenue to 20 to 25 times. Still a premium, just a more normal one. On $7.2 billion of revenue at 22 times, you get a market cap of roughly $158 billion. That is $65 to $70 per share, a 55% decline from here. And it does not require the business to fail, it just requires growth to normalize faster than the market currently expects. Then there's the base case. Here, revenue hits the $7.2 billion in guidance. Growth moderates to 40 to 45% by Q4. Commercial momentum stays strong but decelerates. Multiples compress modestly to 35 to 40 times forward revenue as the growth rate comes down. On $7.2 billion at 37 times, you get roughly $267 billion. That is $110 to $115 per share. Slight downside from here. And ultimately, the stock drifts while the fundamentals catch up to the valuation. Strong company, but you're paying full price. And then there's the bull case. Here, revenue exceeds $7.5 billion for 2026. US commercial accelerates towards $800 million plus per quarter. Government entrenchment deepens. Net dollar retention pushes above 145%. Customer count crosses 1,200 customers. The market maintains or expands the premium 45 to 55 times forward revenue because the growth and profitability combination is genuinely unprecedented. On $7.5 billion at 50 times, you get $375 billion. That is $155 to $160 per share, about 7% upside. But with the optionality that if growth sustains into 2027, the stock re-rates significantly higher. Now notice the asymmetry. It's not a favorable one. The bear case is minus 55%. The bull case is plus 7%. At $146 a share, the risk reward is not obviously attractive. This is just the honest conclusion that I think a lot of Palantir analysis avoids when it comes to bull arguments. The business is exceptional. The moat is real at the complexity tier. The bear case on competitive dynamics is mostly wrong, but the stock is priced for a very specific outcome. Sustained hypergrowth at unprecedented profitability, and even modest disappointment reprices it sharply. This is not like UiPath, which was the last company I covered on the channel. In that episode, the bear case was already baked into the stock. With Palantir, the bull case is already baked into the stock. You do not need a bear case to lose money here. You just need the base case to become a reality. That is why the monitoring framework matters so much. You need to know in real time which case you are in. If you're too slow, this price will swing violently down if something is off from expectations. Now, all of that analysis is great, but stories do not pay. Numbers do. So that's why we track every KPI, every signal, all three cases on one screen. When Q1 earnings land on May 4th, I drop the report and the system extracts them, and every KPI instantly shows as a bear, base, or bull. For example, if revenue in Q1 comes in at $1.55 billion, this is above base, tracking bull. If US commercial revenue comes in at $480 million, it's tracking bear. Each KPI gets a verdict. The picture then aggregates them. This is how the thesis stops being a narrative and becomes a decision framework. So now that we know what to watch, let's see when we get the answers. Checkpoint 1 is May 4th, is Q1 2026 earnings, the single most important print. Does revenue beat the 1.536 billion? Does commercial hold above 540 million? Does management raise guidance? A clean beat with rising guidance puts us in the base to bull lane. A miss, even a slight one at this valuation, changes the conversation immediately. Checkpoint 2 is in early August with Q2 earnings. 2 data points. If growth has dropped below 55% and commercial is flat quarter over quarter, the valuation compression thesis gains real evidence. Checkpoint 3 is in early November with the Q3 earnings. Lapping the $1.18 billion and 63% growth quarter where the stock hit all-time highs. If growth is still above 50% against that comparative, the bull case is alive. If it's in the 30s, compression thesis will win. And then there's checkpoint 4, which is early 2027 with the full year 2026 financial results. Here we need to know, did they hit the $7.2 billion in revenue? Can they guide for sustained hypergrowth into 2027? That print sets the next 12 months. And so once we've got the numbers, we need to assess which lane we are in. Specific bear signals to watch out for is if 2 or more of these appear in the same quarter, the bear case is likely on track. Number 1 is that US commercial revenue comes in below $490 million in any quarter. Number 2 is that net dollar retention drops below 130%. 3 is that deal sizes compress, fewer deals above $10 million than the prior year quarter. 4 is that management holds rather than raises full year guidance after Q1. And number 5 is a named Fortune 500 customer publicly replacing Palantir with a direct model provider solution or an internal build. And likewise, we have specific bull signals to watch. If these signals are intact, the bull case is alive. 1 is that US commercial exceeds $600 million in Q1. 2 is that net dollar retention pushes above 145%. 3 is customer count crosses 1,100 with accelerating large deal additions. 4 is that management raises full year guidance above $7.5 billion in revenue. And then 5 is a major new government program of record beyond Maven and Army. So let me zoom out. The business is genuinely exceptional. The growth is real. The economics are elite. The competitive position in complex enterprise and government AI is more durable than the bears are currently giving it credit for. They are confusing model intelligence with production integration, and the historical pattern says integrated platforms win at the complexity tier Palantir currently operates in. But unlike UiPath, where the bear case was already priced in and you literally just needed the business to survive to make a return, Palantir stock already prices in the bull case. At $146 a share, you need sustained hypergrowth and extraordinary profitability for several years just to justify the current price. And then you have the base case, which is you've got the strong company, but moderating growth and actually implies a slight downside. That does not mean the stock price will go down. Markets can stay expensive longer than any analyst expects. And if Palantir genuinely sustains 60% growth at 50% free cash flow margins, the valuation may prove justified in hindsight, but the margin of safety is thin. And so at the time of recording, at a market cap of $350 billion, price to sales above 78 times, a forward PE above 110 times, I am watching the 12 signals. I know the KPIs, we've done the analysis, and so all we can do now is wait for Q1 earnings to identify which case we are in. I'll update this after Q1. See you then.